Good morning and welcome everyone, and thanks for joining us today. Really appreciate you giving up your time in the middle of the day. Appreciate it's a busy time of year. So the topic today is build your financial roadmap, and it's really focused at ensuring that we have a 2020 financial roadmap in our businesses. It's a very important topic, and one that we've had a huge amount of interest in over the past couple of weeks. It's a very relevant topic we find at this time of year. So we'll run through the agenda shortly. There will be time for Q&A at the end, so feel free to pop any questions you have in the chat box as we go, and we will try and ensure we cover that off at the end. There will also be a very quick feedback form at the end of the webinar. We'd appreciate if you could fill that out. So, very quick introduction to Quantum for those on the call that aren't familiar with us. So, we're a business advisory and accounting firm based out of the Sydney Basin. Core four services are accounting, business tax, and corporate advisory. And we've got a small team of 23, I believe, and really focused on small and medium family enterprise and helping them grow and succeed. So speaking on the call today, myself, Alistair, I'm the MD here at Quantum, and we've also got Patrick Connolly joining us. He's the Accounting and Business Services, one of the Accounting and Business Services managers here at Quantum. Can you give us a very quick introduction on yourself, Patrick?
Thanks, Alistair. Hi, everyone. As Alistair said, I'm one of the Accounting and Business Services managers here at Quantum. My experience has all been in compliance and advisory in the accounting space. Previously managing a portfolio of medium and large businesses at one of some of Australia's largest firms. And I can tell you, Alistair, even for those businesses, this topic is something that people struggle with at every level, and it's something that no one, well, not nobody, but a lot of people are not getting right, even at that level. So to run through the agenda, we're trying to break this down into three key areas. First of all, we want to go through some of the common reasons why planning fails, and just have a look at the key reasons why financial controls can fall down. Then we want to have a look at what a good roadmap does look like, and go through the core requirements or elements of a decent financial plan and what's required. And then we want to spend a lot of time looking at what we call where the rubber hits the road, and we want to go through some practical examples and walk through the elements. So as we go through, bear in mind this is not just all going to be theory. We're going to go through in the first couple of sections a fair bit of theory, and then we're going to go and spend a fair bit of this time going through a practical example and using a tool we've put together. And as Alistair said, we'll have some Q&A time at the end of the presentation.
That's good. Thanks, Patrick. So first up, we want to discuss, as Pat said, why planning fails, what we call the planning trap. And in my mind, I think there's probably two reasons. And the first is that half a plan isn't really a plan. And by that, I guess to demonstrate that point, when we talk about planning, there's really three elements of planning. So you can see on the screen there, we've got strategic planning, financial planning, and tactical planning. And whilst we're focused on financial planning here today, or building your financial plan for your business, we can't look at it in isolation. So when planning works best is when all of these three elements are working together and building off each other. So these are the three core fundamentals of planning, and I would say probably the biggest failing is when developing a financial plan is that it doesn't refer enough back to the actual business strategy. The second area that we find often is, and it's perhaps an overused phrase to some extent, but hope is not a strategy. And by that, I mean that too often we see business owners and management teams perhaps have put a plan together, but then in the managing of that plan and actually working that plan throughout the year, when underperformance happens or when things go perhaps not according to plan, we're relying on hope as a strategy. So we have a bad month, or expenses are above where they should have been, or perhaps gross margin is falling short, And the general tendency is to make excuses or to just assume that things are going to get better. And it's not really a good way to actually operate your plan throughout the year. So that's really, I would say, the second great failing of planning is not actually working and managing the plan as we go through the year.
And I think that sometimes, Alistair, would you say, it comes down to having not put some of that science and reality in up front, that when things do go off track, there's like you said, there's that tendency to say, well, we'll catch up later, but maybe we're not testing the fundamental assumptions as to why we planned that way in the first place.
Yeah, that's good. So when we look at, I guess, the planning types, and I'm sure some of those on the call would probably identify with some of these, but these are really the key planning types that we come across. So when you put the challenge to somebody, have you got your financial plan for next year? These are some of the responses really that we get. So what's a financial plan? Some people perhaps actually don't know where to start. Maybe we've got a sales forecast, and that's really as far as the planning has gone. Probably one of the most common is we have a look at last year, maybe add a few percent along with the sales forecast and hope for the best. At the other end of the spectrum, we've got analysis paralysis, so it's where somebody might take weeks and weeks and perhaps months building their plan and analysing everything, putting so much effort into it that they really go over the top. What we refer to as the Goldilocks plan is really where we want to be, so it's perhaps not too hot and not too cold. It's just right, so it means we spend enough time, but perhaps not too much time getting it right and actually running through the core fundamentals of planning. And then in some businesses, particularly perhaps some of the larger businesses on the call, really we push it back to the finance department, to develop the financial plan for the year, develop the budget, and it's very easy perhaps to shift it off your plate and really just leave it to the finance department. So there should be a poll on your screen. If you haven't filled it in, just throw that. We can see some of the responses coming in, and it's very interesting to see. We've really got a good mixture, I would say, across the board. Probably only about a quarter or a bit less than a quarter of those on the call at this stage really saying that they're getting planning right. So outside of that, really a good mix of responses right across the board, and I think that demonstrates people struggle with that. So I think we'll try and publish that poll result now, so we can see, share with you what we can see here, and you can see across, like you said, Alistair, across the board, lots of different responses. People are approaching this in lots of different ways. So to move on to the next part of our presentation, we want to look at what a good roadmap does look like. And there's seven core requirements as far as we can see as to what is required for a good and robust financial plan. The first element being that you need to learn from history and understand where you've come from. And that means it's important to understand where you've had success or where you've had failure in the past before you can look at the future and set a new plan. Look at what your planning process has been before, what you've got right in that plan when you compare it to actual numbers from previous years, what you've never really managed to predict correctly, and then test some of those assumptions and see perhaps where you can improve your planning process. Yeah, that's good, Patrick. And I like to quote Winston Churchill, who says, "Those who fail to learn from the past are doomed to repeat it." And I think it's true in the planning process, isn't it? Whereby perhaps we've planned before and we've had some wins and some fails in that planning process, but unless we're actually building off that planning process that we've had previously, we're not consistently improving it year to year.
Yeah, and we find that those who are really good at planning and forecasting, they've actually refined that model over 2, 3, 4, 5 years. It's not something that necessarily we're going to get right first go. It's something that we'll get better and better at as long as we keep learning from what's worked before. The next element is that it really, really needs to link with strategy. So you can't have a financial plan if you don't know what you're planning for. You need to have the destination in mind before you decide how to get there. And this sounds really obvious, Alistair, but it's something we come up against all the time, is that the financial plan is an exercise in isolation. It's a budget where we don't really know what we're aiming for as long as we're making money, and the numbers don't seem to come from anywhere with any particular purpose. But it's obviously really important that if you've got a strategy plan in place, you know what you want to achieve, you know what the objectives of your organisation are. Your financial plan is the backup to that. It's the resourcing and the testing to make sure that it makes financial sense. So the next element is that it needs to be realistic and not just optimistic. And this is really about knowing the difference between a sales forecast and a financial forecast versus some sales targets and financial targets. So your target, it's really important to have sales targets, and that's something you would share with your team. Those are aspirational. They're reaching for improvement above and beyond previous years. But when we're doing our financial plan, and bearing in mind this is the plan that resources our business, we need to be realistic. We need to look at what our sales forecasts are, and we need to document our assumptions that let us get there. We need to have some idea of why we're picking the numbers we're picking, and we need to have gone through a process to get there.
Yeah, that's good, Pat. And I think from reflection on seeing a lot of forecasts, a lot of plans over the year, it's one of the common themes, one of the most common themes, I guess, that I've seen, and I'm sure you've seen, is that we've got optimistic sales numbers built into the forecast, and therefore, as soon as we hit some headwinds in the sales area, our forecast falls down, because everything below that top line revenue number was built on the assumption that our sales were going to hit these numbers. And so the financial forecast falls over very early in the year if our sales forecast is too optimistic.
Yeah, and that leads to the next element that we've got here, which is you need to have a revenue model. You need to understand that the revenue line, that's the largest number in your financial plan. Where did it come from? What's the science behind it? Gut feel or add 5%, that's not going to work. We need to know that we understand if we've got a revenue number on our financial plan, where did it come from and how are we going to substantiate that?
Yeah, it's good, Pat. And as we said before, it's the largest number in the whole plan, isn't it? It's the largest number in the forecast. And, you know, if there's not some science behind it, A, it probably won't be accurate. But then B, when there's a variance, you might say, in our actual results to what our sales forecast was, do we know why and where the shortfall is? Or perhaps, you know, on the other extreme, if we've exceeded that sales forecast, it's not just, well, that's history, that's what's happened, but we understand the reasons behind it and how that ties into our assumptions.
Yeah, and this will be different for different businesses and different business types, but your financial plan is going to provide the resources you need in all sorts of areas, in HR, in marketing, in sales, in all the areas of your business. It's going to be geared around the revenue and the type of revenue that you plan to achieve. So if you haven't broken down what parts of your business you expect to have growth in, then when you overachieve or underachieve in your revenue targets, if you don't know where that's come from, how do you know how to adjust the rest of the elements, the rest of the costs that drive that type of revenue? And that's why it's really important that the revenue model exists and is detailed enough so that we have an idea of what we expect to happen. The next element we wanted to cover off is, this is your chance to save money when you're doing the financial plan. You'll never have another chance in the year to actually review and justify every cost in your cost base, to go through line by line and actually look at what is essential and what isn't. And so generally we would recommend that we start with the big ticket costs, you know, and not just looking. A lot of people will go straight to overheads thinking that's where the easiest place to find savings is, but also looking above the line at your suppliers and other direct costs, and actually taking the time to go through and look at things that we might take as assumptions, like, for example, you know, your HR costs, often the biggest cost in your business. Are we just taking last year and adding 2.5% for a general increase, or are we going back to a zero-based budget and looking at what our requirements are, what's happened last year that led to that number, and whether that number needs to be higher or lower than last year, whether there needs to be growth in our HR expenses or not, depending on the rest of our financial plan.
Yeah, that's good, Pat. And once again, I guess just a practical example of that. So often I see, you know, a HR, you might say a cost budget for HR that's set, and it's based on the assumption that we're gonna add 2 people, you know, at 80,000 each next year. So we'll just throw 160,000 onto last year's number. It doesn't account for any timing issues. You know, that one of those people is not going to start until the second half of the year. And so, once again, we're talking about probably the bigger, you know, some of the bigger numbers that are in that financial plan. Just take some time to actually build it from scratch and get it right.
Yeah, absolutely. And then moving on to the last element we've got here, and perhaps I would argue the most important, is that we need to make sure our financial plan is funded. And what we mean by that is that when we're going through our financial plan, we're focusing on our profit and loss. We're looking at what we expect our revenue to be, what costs we need to achieve that revenue, where we want our profit to land. But none of that's going to work for you at all if we're going to run out of cash in the meantime. We need to understand the cash requirement. We need to look, once we've done our forecasts and our budgets, we need to look at what the implications are of that budget from a cash flow perspective. And this is going to be different for different businesses depending on your working capital and other capital requirements. But we need to know, are we going to be growing broke? Are we going to be stoking up cash in our growth? And if we are, how are we going to fund that? What sources of funding do we have? When do we need to have them? And you know, what are our interest and other funding costs, and do they need to be factored into our plan as well?
Yeah, that's good. And in particular, focusing on the working capital movements and understanding what those requirements are, but also what the levers to that are. So when doing the plan, it's a dynamic requirement, isn't it, in relation to funding. So we can say, okay, well, based on where we are now at, you know, with debtor days of X, and this is our inventory turn, this is what we expect our cash requirements to be. But then using that to actually challenge some of those numbers and say, well, what if we actually, you know, could reduce our debtor days, you know, from 60 to 52, and what if we could actually, you know, pull down our inventory turn from 140 days to 120? You know, these are levers, frankly, in business that we probably don't concentrate on enough, would you say?
Yeah, absolutely. And not to harp on the point, but it's really important that when we play with those levers as well, Alistair, that we make sure our assumptions are still realistic. And, you know, like you said, it might be possible to go from debtors days of 60 to 52. It's not going to be possible for most businesses to go from 60 to 45 in 1 year. So we need to be aware of those levers. We need to look at their impact on cash flow and keep in mind all the time, what can we realistically achieve in terms of change in that 1 year?
Yeah, that's good. And I think we perhaps just going back probably a couple of points when we spoke about our profit plan, if you like, our financial plan linking with strategy. It's also a chance to challenge the model, isn't it? To challenge the profit model. So to understand, okay, well, this is where we were last year, and if we just have more of the same, well, you know, this is, you know, a bit of growth and allow for some expenses, that's fine. This is where we're going to end up. But perhaps turn that on its head. You know, look at some items like some power of one modelling. If we pull these levers that we've been talking about, maybe as we said, turn it on its head and look at a profit first budget. You know, so if we were at $500,000 profit last year and we went through an ordinary budgeting process, well, with a bit of luck, you know, we might get 600 or 700. Well, what if we said, no, we're not happy with that. We want to start with $1 million profit. So start there and build your model from the ground up, and therefore where do those other numbers need to fit in?
Yeah, really about integrating with strategy. So we might move on now and have a bit more of a look at where the rubber hits the road.
Yeah, just the final point, Pat, just before we do, was, and this probably along with funding, once again, is probably the two most important elements, and that is to keep your plan alive. So we spoke about it, didn't we, probably at the start of the call, in relation to not just planning being a once-a-year exercise, but that we actually work the plan, that we report against it.
Yeah, look, absolutely, and this needs to be built into your strategic plan as well at the start of the year. Is how often is this going to be reviewed? What's your review cycle? And when you have these reviews, whether that's a monthly or quarterly, or maybe for some management teams even more regular, when things aren't going to plan, you need to be agile enough in your planning that you can change, you know what levers you need to pull when expectations are either not being met or being exceeded, so that you can respond quickly and adjust your plan, really adjust the set of your sales to meet the environment you're in.
That's right, that's good.
So moving on to the next part of our presentation, where the rubber hits the road. We wanted to spend some time now, Alistair, going through some practical examples, and we've got our financial roadmap tool we've developed, which we'll bring up for you now.
So we assume that that those on the call can see the plan on the screen. And I guess, Patrick, we went through what we feel those 7 core requirements of planning are, and how they work together. So I guess coming out from there and looking at some practical elements of how do we, what does that actually look like in real life? And of course we understand that there's so many different, you might say, methods of planning, and even across the breadth of people we've got on the call today, that there will be various various different strategies, and also businesses of in different stages and at different sizes. But the core, you might say, the core methodology really remains the same, across most sizes and industry types, doesn't it?
Different levels of detail make sense for different businesses, and the time and investment into this plan will pay back depending on the size of your business. But yeah, Alistair, like you said, the core elements are going to be the same, and so we've got a bit of a process we can go through here and show you how we might put that into practice.
That's good. That's good. So this is a relatively basic, you might say, financial model, just built off the back of Excel, and it really allows us to go through that methodology that we've just spoken about. So the first element really is to review last year. So as we said, learning from history. So we've got provision, obviously, to get our numbers in here from last year, and so that's really the first step. Is to, okay, so what's our starting point? And it has to be the previous 12 months performance. So we get our chart of accounts in, we enter our results for the last year, and we understand what that looks like, and how it really impacts the model all the way down. So pretty basic structure, but that really is the starting point. So understanding how that stacked up, what the So the second point, I guess, once we've got that entered in, as we said, it's a chance really to challenge the profit model, and there's a couple of basic ways that we can do that, and we can see this in this tool. Once again, it's relatively straightforward, but it's something that, frankly, a lot of business owners and management teams just don't spend enough time doing. So the first you might say model is what we call the power of one, and it's predicated on the assumption that if we change one of these drivers by 1%, what will be the impact on our bottom line? So this champion manufacturing company that we've got here, we've got some basic data that's been entered in, and they had a starting position with a bottom line of 300,000 last year. So by tweaking these elements here, so we've got really five core profit drivers, you might say here. We've got price, we've got sales volume, we've got cost of goods sold percentage, direct costs and fixed costs or overhead costs, and just understanding what that looks like in terms of results. So we can see changing those drivers there by 1%. So 5 drivers by 1% means our net profit has improved by 37% to 413,000. And we can look at various strategies on how to do that, can't we, Patrick? But just understanding how these elements work together, and we can look at we can look at the difference between a price increase and a volume increase, and the impact that will have. 1% is a starting point, but what happens if it's 2 or 3%? We can make some pretty significant changes. Just with those changes we've got there, we've got a 2/3 improvement in bottom line.
Yeah, I think this is a really useful tool sometimes for the management team to be looking at. It can be really easy when we're going through this budgeting process to focus on revenue or volume and just look at, if we can pump and pump and pump, what does that do to everything below the line? Whereas this really puts into focus that we're all in business to make profit, and profit's driven by more than just revenue. And, what's going to be easier? Is it going to be easier to increase your revenue by 15% to achieve that increase in net profit? Or is it going to be easier to try and focus on finding your 1% or your 0.5% in all these categories and having the same impact?
That's right. That's good. So that's certainly something that I would recommend when setting your financial plan that you have a look at, and not only probably once in the year. It's something that we can do on a regular basis throughout the year, and trying to pick up those 1% here and there across these various drivers. It should be a consistent focus, really, I would say, for the management team. So the second model is what we call the profit plan here, sometimes known as the profit first model, or perhaps a bottom-up budget. And as we alluded to earlier, it turns the budgeting process on its head and starts with the end in mind. So if we said that we had a $300,000 bottom line last year in this champion manufacturing company, where do we want to be next year? So if we want to increase from 300 to 500, maybe we're looking at what we want to actually pull out of the business. What our, you might say, our survival break even is, or how much debt reduction, how much drawings we want to take out of the business, and just starting with the end in mind. And then once again, we look at, okay, if that's the result that we're looking for, what are the drivers that actually have an impact on that? So we've got overhead expenses and the GP and margins and costs, and really understanding how these drivers work together to impact on the sales, you might say, on the top line requirement. So if we said that, okay, well, our overhead expenses won't remain the same, we probably need to allow a bit of increase there for next year. And then, other income, well, we'll just keep that more or less the same. Our direct costs, we need another person in the warehouse, so we expect that's going to increase next year. And then we're looking, I guess, at the final driver, really, which is our contribution margin, or what our direct costs percentage is. We might look at that and say, well, we're actually expecting some cost increase from our suppliers that's going to impact that. We might allow 52% on that number. All right, and all of these items really come together to say, okay, well, based on these assumptions, well, this is the revenue requirement for the year.
Yeah, that's right. And it gives us these two tools, Alistair, can obviously be used together, not in isolation. And you can see that, if we've got a profit objective in mind, what does it look like if we change nothing? What does it look like if we change a few of those drivers? And where does that leave us from a revenue target basis? Yeah,
that's good. I think probably the key takeaway out of this is to actually take the time in the process to challenge the results of what we've had historically, and perhaps to challenge our perception of what the results should be, and understand how these drivers work together, and how we can make them work together to achieve a better result. So if we've gone through those first two steps, so we've reviewed last year, we've had a bit of a play around with our profit models. It's really time to do a first, what we call a first cut budget, and that is really just you might say, a very high level sort of first stab at what our results are looking like. And so in terms of the budget process, we don't really need to spend a lot of time actually doing that. All right, it's just a case of having a look at last year, starting off with some key assumptions, isn't it, Patrick, and just getting that first cut done.
Yeah, so your first cut's just going to be back to that gut feel. How do you think things are going to go? Looking at your expenses from your experience, what do you expect? And just getting those numbers in there so you've got a starting point, because of course we'll go through and we'll challenge and substantiate all those through this process.
Yeah, that's right. And I think it just gives you, without going through all the detail and then realising that we're going to be, 300,000 short of the profit number that we're looking for, and having to rework the whole thing, we get that first cut out of the way really quickly and say, okay, well, these are based on some key assumptions, but we're going to be short, or no, we're about where we expect to be, and it just gives us that initial starting point, doesn't it, to build the rest of the forecast off. So that's step 3 is to get that first cut done. The fourth step is to challenge the costs, and we went over this earlier in the methodology. And it's absolutely critical to spend enough time here to challenge the cost, because as Patrick said, we're not going to have a better opportunity throughout the whole year than at this point when we're setting our plan in order to challenge costs and actually save some money. It's a real opportunity to save money on the one hand, and also challenge whether some costs are actually necessary. Are we actually getting a return on these costs, or is it just dead money? So in order to do that, I think there's really two key points, I would say. And the first is start with the big ticket items. So don't worry too much about the loose change. Start with the big ticket items. And the second is making sure that we actually document our assumptions. So probably if we went to HR first up, is probably the biggest ticket item, certainly after cost of goods in most businesses, sometimes even higher. And as we said, actually having a HR model and modelling out that forecast to get an accurate position of HR costs, rather than just working off last year and adding some assumptions on the top.
Yeah, because you can get a really good idea through doing this of exactly who you're going to pay, exactly what you're going to pay them, and when you're going to pay them. And that works a lot better than taking last year and adding a percentage, obviously, because throughout the course of a year, a lot happens. You might have had periods where positions were unfilled. You might have had periods where you're using extra casuals versus permanent staff for whatever reason. So going back to taking the time to do this from a zero base, starting with nothing, and putting in through this work paper or something similar, exactly who you expect to pay, when you expect to pay them, and what you expect to pay them, you end up with a much more reliable number.
That's good, and probably just some other practical points on why it's important to use this methodology. Is a simple one, for instance, is allowing for the impact of pay periods on individual months. So we might pay fortnightly, which means that for a couple of months in the year we're going to have 3 pay periods instead of 2. And when wages is such a high cost, that'll be the difference between whether we make a profit or don't make a profit sometimes in that particular month. And so rather than just spreading it out across the year, we allow for that extra week or that extra fortnight. And that's just one practical element that comes up so often, and our forecast is out of whack because we actually haven't allowed for it.
Yeah.
So having that plan, we're allowing for the difference between direct wages, obviously, and overhead wages. We've got our superannuation calculations. We've got our payroll tax calculations in there, and it's a solid and substantial and reliable way of actually forecasting our HR costs. So we come from there, and then we look, don't we, at our other costs, don't we, Patrick? And as we said, challenging those costs, going back and reviewing last year, and understanding what's our previous spend been, what can we justify, what can't we justify, what can we cut, and actually putting those assumptions in.
Yeah, and so, sometimes just a really practical step can be, when you're looking at those large overhead accounts, actually take the time to export last year's GL to Excel. Sit there and look through each line, and have a look at what you spent and analyse whether or not you think that spend had an impact on the bottom line. If it did, it's justified. If it didn't, why did we do it, and do we need to do it again?
That's good. That's good. And so, once again, a pretty practical example of a, or you might say a common example where this is relevant. We might pick marketing costs. You know, obviously a lot of businesses that we have some pretty substantial marketing costs. You know, when they're up around the, you know, the 3-4% of revenue. You know, we're getting marketing budgets in the, you know, in the well into the hundreds of thousands of dollars. Without actually challenging those costs and understanding, is this actually a good spend? So this is a good chance to actually look at what we spent last year, get some detail around it, understand, you know, what were the elements within that marketing spend, and challenge each one. You know, we might have spent, you know, $30,000 last year on SEO management, and, you know, when we challenge it, we feel that it really wasn't a good spend. We might actually take that spend and perhaps not even cut the spend, but redivert it to something that's actually going to have an impact.
Yeah, and sometimes when we're dealing with those big marketing budgets, it's actually a good idea to put that back on the provider to do that work for you. You know, make them tell you why that money was well spent. Let them show you the return that they can substantiate for you.
Yep. And the other thing in mapping out these expenses is really accounting for timing differences. So it's very easy, isn't it, just to get a total spend and just map it out evenly across 12 months. When we know full well right at the start of the year what those timing issues are going to be. You know, we expect to have a lump sum on this particular cost in December. Well, let's actually allow for it in December, rather than have our budget, you know, be out of whack for the whole year on that particular item. Another area just comes to mind, Patrick, that is ripe for review. I would say, particularly in this day and age with so much what we call software as a service, is subscription costs. Whether that's software subscriptions or training or you know, there's a whole element of you know, subscription providers across a range of categories. It's actually to do a subscription review, and something I'm sure you do. I do to a lot of my clients, is to recommend they have a subscription review at least once every year. So what are we paying out on an agreement every month? Actually challenge those costs, because it's very easy when it's set and forget that the money just comes out of the bank account every month. Yeah,
and that's really important, Alistair. I think when you're, you know, a family business that's growing, and you're perhaps at a bigger size than where you started, perhaps management's not really aware anymore of all those little things that are coming out that can add up to a significant amount. So just to print that off, look at what you spent, and make sure you're getting value out of all those subscriptions can be a really quick way to save some money.
That's good. So I think in wrapping up, to delve into and what we need to detail in terms of assumptions and breaking out the costs, and we can use you know, some expense work papers and get some calculations in there, and then some of the other items, you know, for instance, bank charges. You know, it's really not worth going into the detail. Of course, we can just map that out. We can auto-fill some costs really across the, you know, straight across the screen and move those out quickly and concentrate on the stuff that matters. So if we've come through those first 4 points, so we've reviewed last year, we've tweaked our profit model, challenged those, we've done our first cut, then we've come back, we've challenged the costs, we've really nailed down on the expenses. It gives us a better indication before we look at revenue again, where that result's going to be, Patrick, and then it's a chance to really to look, as we said, at that revenue model and check those revenue assumptions.
Yeah, we've got to go through a really similar exercise to what we've done with our expenses, and that is look line by line. You know, look, rather than taking, you know, last year we did 8 million, this year we want to do 10, and therefore we divide 10 million by 12 months. Look at, you know, which products, which services, what's the seasonality of each, what stage, what in the life cycle is each product up to, and really map out properly with some documented assumptions where that income is going to come from.
Yeah, that's good. And there's a bunch of different models we can use depending on the industry type and the stage of the business. You know, we can look at product groups or customer groups. We can look at income from geographical regions. We can do some pipeline calculations based on opportunities and conversion rates and so on. Perhaps, for businesses that might be more, steady merchandising businesses, we can look at, how many working days in a particular month and average daily sales and account for some growth. I guess we can look at just having perhaps setting some growth rates and allowing for seasonality. There's a multitude of different ways of breaking down that revenue model, but we need to have something that we've got our sales forecast based on, with some core assumptions, so that when there's a variance, we know not only where the variance is, but why.
Yeah, and it's good, like you said, Alistair, to have some lead measures of that. So if we're looking at, for some businesses, it can be done that we break down what's that conversion rate, therefore how many leads do we need, how many inquiries do we need, and that's information we can get in real time. Almost, we can see what's coming through the door every day, and that gives us a good indication of whether these targets on an ongoing basis are still sustainable.
That's good. So then I guess we come from there. We've gone through the first 5 points. The sixth point is to understand cash requirements, and we went through it in the methodology. And this is the most important point at this stage, is to understand what the cash flow impact of our P&L budget is. And obviously there's a few drivers that impact on that. So in particular, some of those working capital numbers, obviously profitability. What are the balance sheet movements? But here at this point of the financial plan is our chance to map out, I guess, what we'd term the strategic cash flow for the year. It's not something. Perhaps this model is not something that is going to be your internal cash flow management tool. In that you will need to. As you go through the year, you'll need a more workable model, a more live, you might say live and up-to-date model than this. But this exercise at this point is critical to map this out to understand, are we going to be able to fund our growth, for instance, or are we growing broke? Yeah,
and so this tool we've designed in mind to look at what's the cash flow impact of this particular profit model. As Alice said, it's not going to tell you what's going to be in the bank account at the end of next week, but it's going to tell you that if we operate according to plan, what's the overall impact on cash going to be? Is it going to be positive or negative, and by how much? And the other thing that can be really relevant here in this tool is it can help us to challenge some of our assumptions, as we said earlier, not just around our revenue model and our profit model, but also challenge assumptions around that working capital ratio. When I'm talking to businesses, a lot of business owners or finance managers will go straight to stock. If we're going to grow, we need a lot more stock, and overlooking the fact that what's it going to do to our debtors, what's it going to do to our creditors, and if there's been a change in strategy, if we're chasing larger jobs or we're chasing those larger customers, does that create a change in our debtor profile? Can we expect that it's going to take longer or not as long to get paid, and what does that do to cash flow? And so that's why it's really important that we allow enough time to consider this properly.
Absolutely. So that's good. So if we look at this, you might say this initial model for good old Champion Manufacturing Co. We can see that straight away, very early on in the year, based on the assumptions that we've got in, we're going to have a cash flow problem. We're already into negative territory, and sure, it eventually fixes itself up. So later in the year, we're back into positive territory. Okay, so at a strategic level, we understand that we've got a cash flow problem that we've got to be planning for now. And so, what are some of the levers that we can pull? So sure, we could perhaps say, okay, well, we might be able to get some short-term finance from the bank, maybe an overdraft extension, so we can map that in, and that might fix our cash flow situation for this period. We can pay it back later. Straight away we're in positive territory. So that's one lever that we can pull. But we really should be, particularly in merchandising and manufacturing businesses, we really need to be looking at the working capital requirements, don't we? Yeah, and I think the most important takeaway from that example is that this revenue model shows that this business is a profitable business. It was going to make profit over the year. But if the management of this business hadn't planned their cash flow, they might not have seen that coming, and the whole thing could have been derailed. Absolutely, and then we might look at, as we said, in this working capital, so management. So we're talking obviously debtors, creditors, and inventory. We can't just expect our working capital to stay static or steady across the whole year. There might actually even be seasonal variations that we need to take into account. For instance, we could say, okay, well, in inventory we've got inventory days of 120, but then perhaps towards December or the end of the year or the start of the year, we're actually we're building up stock, importing a lot of stuff from China. Got to get that product in before the break for Chinese New Year, and so our stock holding, for a period of 3 months is going to go up from 120 days to more like 150 or 160. So we need to have provision to actually map out that cash flow impact. And sure, it's not, we're working off some sort of best case assumptions ahead of time, but it's better to do that now with the information that we have rather than down the track when we're in a cash flow crisis.
Yeah, and that's the importance of documenting, because we'll find instinctively business owners know this. People who have been in wholesaling or manufacturing, they're importing, they know exactly what their crunch times are, but often the time's not taken to just put it down on paper and actually map out the real effect, so we can see in dollars what that means. That's good.
So that's I guess a pretty simple model of an Excel tool. It will be provided for those that feel it would be of benefit at the end of the call. But I guess it just sets out in some practical examples of how we go through this planning methodology with a solid process and a structured methodology to make it work and ensure that we look at all the moving parts.
Yeah, and it's going to give us, at the end of this process, it's going to give us a plan that we can then, as we said earlier, just keep report. It keeps coming back up for management. We review our actual performance against this budget, and it gives us that roadmap for the rest of the year.
Yep. And I think we said it earlier. Probably the two most critical elements are obviously the funding requirements, but then keeping the plan alive. So reporting our actuals against our budget every month. As far as I'm concerned, that should be a non-negotiable. So we should have our budget in place, and we're reporting actuals against budget every month, so that we can work the plan, we can keep it alive, we can understand. Okay, well this is where we said we're going to be. This is now the real life scenario. We're in front or we're behind, and these are some of the things that we need to do to adjust for where we are now, so that we're still on track to get to where we need to be at the end of the year. That's good. So I guess as far as the key takeaways from our presentation today, I guess we can once again break them down into these three areas. So why planning fails, what a good roadmap looks like, and how to make the rubber hit the road. So first up, why planning fails. We went over really the two core elements there, and that is having half a plan. So having a financial plan that really doesn't interact and integrate, with the strategic plan, and also perhaps the tactical plans. And then secondly, being, I guess having hope as that strategy, or just making excuses as to why performance isn't where it should be, or why results are different to what we expected them to be, without actually putting some rigour into the process and saying, we're off track, this is what we need to do to get back on track. So then what a good roadmap looks like, I think we went through the 7 core elements there. So a good roadmap, it actually learns from history, it links with strategy, it's realistic, it's not optimistic, it has a revenue model, which is absolutely critical. It actually saves us money. So a good financial roadmap saves us money, so it's worth every minute that we put into it. A good roadmap is funded, and then finally a good roadmap is kept alive throughout the whole year. And then finally, 7 steps to make the rubber hit the road from a practical perspective. So step 1 is reviewing last year and really understanding where we've been, where we've come from, what's worked, what hasn't worked. Step number 2 is to tweak that profit model, really challenge some of the assumptions and some of the drivers and work out how we can change the numbers to get a better result. Step 3 from there is to draft the first cut, so that initial pass of the budget, just to understand what the draft numbers look like. 4th step is to challenge those costs. So take the time really to challenge our costs, challenge our assumptions, and understand how we can make that plan more rigorous and actually save money along the way. Step 5 is to check the revenue model, so ensure that we actually have that revenue model in place. Step number 6 from there is understanding the cash flow requirements, and then step 7, as we said, keep it alive. So report, and report again.
Okay, so next steps. So first of all, we're going to have a bit of a Q&A session, so please feel free to add some questions to the chat now. But I guess to move forward from today, you've got to check your current planning process against what we've discussed today and look at what could be done better, what elements are perhaps missing. And your accountant is the person you should be asking for help. You know, your accountant is the expert in the financial planning process, and you know, please always feel free to reach out to us if you need to. You need to allow enough time to do this properly. So for a lot of businesses, that's something that is done on a calendar year basis. So that might be, you know, we're doing it now or we're doing it in January, but it needs to be something that it's given enough priority that it sets up a financial plan that's going to be used for the year ahead. And you just got to make it happen. That's the final takeaway. So I guess now we'll go to some Q&A. Have a look at the questions that have come through so far.
That's good, Pat. So the first one we've got from John is a 1-year plan the right time frame? Does he say the best time frame, or should we be looking at a longer period? What would you say?
So my answer to that would be that having a 1-year plan is really important. And this is your operational plan. What's going to happen for the next year? It's really important that's a detailed, specific plan like we've just run through. But I would say, Alistair, I think it's important that that's part of a larger framework, and that it sits within, you know, it's not sort of a suite of planning. That, you know, you've also got a longer term plan, whether that's a 3 or 5 year plan, that details out the objectives of the organisation and your broad headline numbers of what you want to achieve over the next few years as well.
Yeah, that's good. And I guess just to add to that, as we know, you know, forecasting is as much an art as a science. But what we do know is that the further we get out, the less sure or the less accurate our assumptions. We've got is around forecasting on a financial year basis or a calendar year basis, and I would say to that really is just whatever works for your strategic plan. So as we said, your strategic plan and your financial plan need to tie together. So I think we get a little bit hung up on the whole calendar year, financial year model. You know, I wouldn't be too concerned about it, but you have to have that planning process being all inclusive. So if you're running your strategy on a calendar year basis, run your financial planning on a calendar year basis as well. Probably the only other thing I would say to that, Pat, is that you should always do a 6-month review. So whether you start in January or start in July, always take the chance to do a 6-month review of that forecast, would you say? Yeah,
look, I guess either way, it's fairly arbitrary, the dates we pick. It's just whatever makes sense for the business and however it lines up with the strategy the best.
That's good. That's good. So Craig says, what are your thoughts on changing the plan partway through the year? Something quite different is happening, so that could be positive or negative to what was originally planned.
Yeah, so I think it's essential that you're able to change your plan as things move, because obviously the environment around you is moving all the time, and that's why it's so important to keep that plan alive and to be reporting regularly. would you say, Alistair?
Yeah, I think that's good. The only thing I would say is you've got to be careful not to move the goalposts. So sometimes we can say, okay, well, we can excuse poor performance by saying, oh, well, something drastic has changed, or our assumptions were wrong, or whatever, and we can perhaps lower our sights. And I would guard against that. So if we're going to, as we said, you know, every plan should have a 6-month review. So a 6-month review is a chance to actually reset and reforecast, but always keep that initial forecast in place, so that when we get to the end of the year, we can still report against, you know, we've still got that on file to report against that initial budget, even though we might have a subsequent budget that is more accurate.
So we've had another question come through from Carl. Alistair, who should be involved in preparing our financial plan?
Well, it's a good question, and I would say it just really depends on who, you know, what your business looks like. But it can't just be left to one person, I would say, and so often I would say that is the case. It's the person, you know, it could be the finance manager, it could just simply be the business owner, it could be the director that has the most to do with the finance. He's the guy with the finance hat on. But it has to be a team approach. So we've got to get the right information from the people that understand it best. So at a minimum, whoever's involved in finance obviously needs to be involved in setting that financial plan. But as we said, because it's linking with strategy, we've got a chance to challenge the model. You know, the people that are involved in strategy need to, you know, they've got to see how that impacts on the finance side of things. We've had a few people ask about whether a recording of the webinar will be available. Our simple answer is yes. So long as you've registered, you should get a recording of that come through. And also a couple that have asked whether the Excel tool that we showed on the screen will be made available. Once again, the answer is yes to that. We've got a question from Karen, just in relation to sales forecasts. I'm not sure that I've got her question exactly clear, but I think she's asking how do we make sure that the sales team and their numbers are tying into this financial process, or this planning process. What would you say, Patrick?
Yeah, and I think that comes back to the point we made earlier a little bit around the difference between sales targets and sales forecasts. And how much you share with the team about what the difference between those two is will depend on your business. But it's really important that everyone in the business, and especially salespeople from this point of view, understand their role in achieving success. So that obviously the individual targets of salespeople need to feed into a budget for the sales team, which needs to feed back into what our expectations are in the financial plan.
That's good. That's good. Sean has asked, do you recommend having a worst case, most likely, and best case plan? I'm probably a little bit controversial on this. I would say no, in that I would always like to see just the most likely case. Sure, within the process, we need to understand, you know, what the best case and worst case implications are. However, I find having multiple versions of a budget with different sales numbers and so on, it gets very confusing on the one hand, and it's also very easy when performance is falling short to say, okay, well, we're not meeting our best case budget, but we're still meeting our one in the middle, so we can sort of excuse that. So I would just rather see. Just get the budget as accurate as you can. Sure, within the process, model out, you know, some what-if scenarios and what happens if sales fall short, or what happens if we add these two people on in terms of costs. But just come back to one version. So
I think that's sometimes there's a bit of a misunderstanding about exactly what a budget represents. Would you say, Alistair? Your budget, as we said, it's got a link with your strategy, and your budget is just a tool that's showing you how you're going to resource meeting your objectives. And so having a best case or a worst case budget, well, if it's worst case, you're not going to meet your objectives, and therefore your strategy's failed. So that's not what we're trying to achieve. The budget is not, your budget is not a target. and it's not a safety, it's what do you expect to happen.
That's good. That's good. So Michael has asked about running a consolidated budget or a consolidated forecast where there's more than one entity involved. So where there's perhaps a main trading entity and then a secondary smaller entity. So he's asked about running a consolidated forecast.
Yeah, I think this sometimes sounds a lot more complicated than it needs to be. Essentially, you know, the legal ownership in different entities, it doesn't need to come into the budgeting process. We just want to look at business units, and that's part of having that revenue model, you know, which you can just as easily say which entities are our sales coming from as you could say which products. So I don't think that would you say, Alistair, needs to be overcomplicated, that process?
Yeah, I think that's probably the key point is not to overcomplicate it. And it comes back to well, what are we actually reporting? If we're reporting on a consolidated basis, and that's what we're doing every month, well, we should have that consolidated forecast, I would say, as long as it's not, as we said, overcomplicating the process. And once again, you know, look at the impact that it's actually having on the overall number. So if adding that other minor entity in is only making a very small impact, well, is it worth the extra complexity? That's all I would say. Oh, that's good. Somebody has asked, Helen asked about analysing costs. What's the best method to analyse costs? So I think she's referring back to when we were speaking about pulling those costs out from last year and using that as a basis for challenging costs. I think you mentioned, didn't you, Patrick, about pulling the GL perhaps out of the accounting system. And for those that perhaps aren't very financially minded, it's not a difficult thing to do. Almost any accounting system, you should be able just to run a report, do some basic filtering and sorting in Excel to understand exactly what was spent in across any expense code, and just do some basic analysis in Excel. So we spoke, I think, didn't we, about marketing costs, for instance. So you can run a GL report on marketing, all the marketing codes for the year, do a quick filter, do a sort perhaps by supplier, for instance, and we can see who we've paid, what we've paid, and use that to help analyse those costs and challenge them.
Yeah, so like we said, you start with your big ticket items. Once you start with your big ticket items and you're happy with those, as a business owner or a finance manager, look at anything that stands out to you as unexpected. That's another good place to start. Anything that seems like it's out of the ordinary. Another thing we didn't really touch on too much, but depending on the industry, maybe there's some benchmarking available to you to look at what other businesses are spending on particular items as a percentage of their sales.
That's good. That's good. Gavin has asked. He's made the comment about having a complete workbook containing all the spreadsheets, including sales forecast. Is this recommended? And do you have a lot of worksheet cells linked to the master financial plan? Once again, I guess we built that basic tool we showed on the screen just to show how the methodology should work, and that I think that's a relatively basic and hopefully not overcomplicated process. So I would recommend having the information together and being able to see what our assumptions are and how things link together. The only thing I would say is just make sure that if your Excel skills aren't great, if you're building it in Excel, just make sure you don't go changing a whole lot of formulas and make sure there's some checks and balances, because it's very easy to get some errors and to be relying on some incorrect data. If we've overcomplicated the thing and something breaks.
Okay, looks like that's all the questions we've got, I believe.
That's good. So we might wrap it up very shortly, unless there's
any final
we might just leave it open for a couple of minutes. If anybody else wants to throw some questions on, feel free. Otherwise, feel free to reach out via email or at any time. Outside of that, we will call it a day. So thanks once again very much for coming along. I really appreciated you giving up the time today. We trust it was useful, and we trust it was understandable. If there's any further questions, perhaps that come up following the call, feel free, as we said, to send them through. When you leave the webinar, there will be a quick feedback form that pops up. We would appreciate you just taking a couple of minutes to fill that out. And if you have any suggestions in relation to future webinar topics or something that you'd like us to dig into, feel free to make a suggestion on that front.
And if you do want a copy of that Excel tool, please make sure you do fill out the feedback form and just tick the box to indicate that, and we'll get that sent out to you.
That's brilliant. Thanks once again. Have a great day.